Hello everyone, our lesson for today is all about the accounting cycle. Each step in the accounting cycle plays an important role in creating accurate entries. So far, you've covered the first four steps that define basic daily bookkeeping. Every transaction made, whether money spent or received, is analyzed so the accountant knows the exact amount, the purpose of the transaction, and the date and time of the transaction, and everything properly documented. Every transaction is logged into the journal, and every journal entry is posted to the general ledger. And then the general ledger is tested periodically by running a trial balance. Now, there are 10 steps in the complete accounting cycle. So, the first one is you have to analyze the transactions. The next one is prepare journal entries and then post journal entries and then prepare adjusted and unadjusted trial balance. Number 5 is make adjusting journal entries. Number 6, prepared adjusted trial balance. Number 7, prepare financial statements. Number 8, prepare closing entries. Number 9, prepare post-closing trial balance. And number 10 is to create and post reversing entries if needed. So periodically, the accounting department must prepare a financial annual report for investors and shareholders. And then the accounting cycle ensures the data presented in the report is organized and accurate. As step 7 of the report involves creating financial statements covering the company's fiscal year. First, though all the accounts have to be verified and adjusted if necessary, steps 5 and 6, and then the financial statements must then be prepared in a certain order. The income statement must be prepared first, followed by the statement of owner's equity, then the balance sheet, and finally the statement of cash flows. At the end of this process, the books are closed to prevent any changes and to restart the income and expense accounts for the next period. Now let's review our accounting cycle again. The first three items represent our daily activities as bookkeeper or keeping the books, like the journal and ledger, and it must be up to date. So the first one is the daily transactions or analyze transactions, prepare journal entries, and post journal entries. The step 4, which is prepare an adjusted trial balance, is something we do monthly or more often if necessary to ensure that everything is in order for step 5, which is make adjusting journal entries. We may do this step monthly or quarterly, but almost always annually. The only reason we wouldn't create financial statements is if we were out of business. But even then, we have to file a final tax return and we'll need financials to do that. Now, let's go to step 5, which is adjusting journal entries. Adjusting journal or adjusting entries reflect economic activity that has taken place but has not yet been recorded because it is neither more convenient to wait until the end of the period to record the activity or because no source no source document concerning that activity has yet to come to the accountant's attention. Periodic reporting and the matching principle may also periodically require adjusting entries. Remember, the matching principle indicates that expenses have to be matched with revenues as long as it is reasonable to do so. To follow this principle, adjusting journal entries are made at the end of an accounting period or anytime financial statements are prepared so that we have matching revenues and expenses. Adjusting entries are made during the accounting cycle after the unadjusted trial balance and before the company prepares its financial statements, bringing the amounts in the general ledger or in the general ledger accounts to their proper balances. Each adjusting entry has a dual purpose. The first one is to make the income statement report the appropriate revenue or expense. The second is to make the balance sheet report the appropriate asset or liability. Thus, every adjusting entry affects at least one income statement account and one balance sheet account. Adjusting entries fall into two broad classes, which are accrued, meaning to grow or accumulate items, and deferred, meaning to postpone or delay the items. The entries can be further divided into accrued revenue, accrued expenses, and earned revenue and prepaid expenses, and a division we will examine further in the next lessons. The adjusting entries for a given accounting period are entered in the general journal and posted to the appropriate ledger accounts. And take note, these are the same ledger accounts used to post your other journal entries. And let's proceed to the three adjusting entry rules. Adjusting entry almost never include cash. The purpose of adjusting entries is to make the accounting records accurately reflect the matching principle, which is match revenue and expense of the operating period. There are some rare cases where cash needs to be adjusted, but ideally, that adjusting should have all been done prior to running the unadjusted trial balance. So, next is debits always equals credits as usual. And then the adjusting entry will have one balance sheet account, which are asset, liability, or equity, and one income statement account, which include the revenue or expenses in the journal entry. Remember, the goal of the adjusting entry is to match the revenue and expense of the accounting period. Adjusting entries between balance sheet accounts only or between income statement accounts only are usually called reclassification. Now, these are the steps of the adjusting process. We can break down steps 5 and 6 of the accounting cycle into a bit more detail. So, the first one is print out the unadjusted trial balance. Next is analyze each account and then look for anything that is missing. Next is make adjusting journal entries. And then the last one is post the adjusting journal entries. This is a systematic way to prepare and post adjusting journal entries that accountants have been using for about 500 years. So let's dig into each step. Step 1, which is print out the unadjusted trial balance. So here, the unadjusted trial balance comes right out of your bookkeeping system. Debits will equal credits. Well, unless something is terribly wrong with your system. However, you have no idea if everything is recorded correctly. This is actually where our accountants' brains really get to work. Then next is step 2. Analyze each account. Start at the top with a checking account balance or whatever is the first account on the trial balance. If it's petty cash, then you should have a petty cash account or petty cash count at the end of the period that matches what is shown on the trial balance, or which is the ledger balance. If they match, then fine. If they don't, you have to do some research and find out which one is right and then make a correction. Then let's go to step 3, which is look for anything that is missing. So as you move down the unadjusted trial balance, you have to look for documentation to back up each line item. For instance, if you get to accounts receivable, you should have a list of all customers that owe you money, and it should exactly agree to the trial balance, which comes from the ledger. The list of customers called a subsidiary ledger should have been updated with the same information that updated the general ledger. So if a customer bought something on account, the general ledger or accounts receivable was increased by a debit in this case, and the subsidiary ledger was increased by the same amount. So the difference between a subsidiary ledger and a general ledger is that the subsidiary ledger is organized by customer and shows what each customer owes or charges less payments. And the general ledger is just a list by date of what everybody owes. It would be a lot of work to sort through the general ledger to find all the transactions for one particular customer. So we have to track that as we go. Conducting a search with a subsidiary ledger means we have two things. The first one is a way to instantly tell how much a customer owes us. Second is a list agreeing with the general ledger account with the details we need to verify it. Back to adjusting journal entries. If you find by investigation, or for example, you're asking questions, doing research, that there is a customer out there who has not been billed yet, and so doesn't show up in the control account or in the subsidiary ledger, you have to accrue or add that revenue by creating and posting a journal entry. Now let's go to step 4, which is make adjusting journal entries. So every time you find an error, an asset or a liability or equity account that needs to be adjusted. So you make an adjusting journal entry and you carefully document why you made it. Those entries are usually dated of the end of the period. For example, December 31, 2021. And if they are numbered, many accountants use the prefix AJE, AG1, like that. So now let's go to step 5. Post the adjusting journal entries. In this process is just the same process uh, you use when recording transactions during the period, like analyze, journalize, and post. Now, in accounting, we classify adjustments in one of two ways. The first is a deferral or an accrual. They are the opposite of each other. If you look up the word accrue, you'll find it basically means to add to. And then the word defer, actually means to put off to later. So in accounting, it's easy to tell if an expense or revenue is deferred or accrued when the cash comes in. If you earn revenue before you get the cash, you have to accrue the revenue or add it to your books. Accrued revenue is an asset or accounts receivable most likely. If you get the cash before you earn the revenue, you have to defer recognition of the revenue. In fact, getting the cash before you earn the revenue means you have a liability, or in other words, deferred revenue is equals to liability. Now, the same idea holds true for expenses. If you pay an expense in advance, like insurance, where you may pay an annual premium that expires, or meaning is used up monthly, you have a deferred expense. A deferred expense is an asset. If you have expenses that you haven't recorded yet, say a bill from your attorney, you have to accrue that expense or add it to your books. An accrued expense is a liability. A stack of coins being measured with a clamp. Accrued revenues are the common at the end of the year when we are doing work but have not recorded the revenue yet. This would also apply to interest earned on notes receivable, even if the interest is not due until the next year. A common example of an accrued expense is when employees work during the last week of the year but won't be paid until the next regular payday, which is in the next year. The expense needs to be matched with the revenue of the period. Interest expense is another example. Since it accrues by the day, we need to adjust for the expense for the amount of time the note is outstanding during the accounting period. There is one more type of journal entry that doesn't fit a tidy classification. For instance, if you find an error or some other material misstatement, you may use an adjusting entry to correct it. Now, in the next section, we'll cover adjusting for deferred and accrued revenues, and then deferred and accrued expenses, as well as other kinds of adjusting journal entries. That way, we need to get our basic bookkeeping records to comply with the generally accepted accounting principles, or GAAP, so we can produce our financial statements. So the next lesson